In 1720, the richest nation on earth watched half its wealth vanish in 6 months, and nobody saw it coming. The standard account is straightforward. A company called the South Sea Company promised investors access to Spanish gold in the South American colonies. Everyone believed it. Stock prices tripled, then quadrupled. Then the whole thing collapsed, ruining thousands. The lesson: greed blinds people. But that's not what actually happened, and understanding why is the difference between recognizing the next bubble and getting caught in it. Let's start with what we think we know. The South Sea Company was founded in 1711 by Robert Harley, a brilliant political operator who needed a way to manage England's war debt. The company would handle government bonds, and in exchange, it got a monopoly on trade with Spanish South America. Sounds reasonable, sounds like a genuine asset. By 1719, the company was profitable but unremarkable. Then John Blunt, the company's director, a man with a gift for mathematics and no patience for honesty, proposed something audacious. The company would absorb even more of the national debt, swapping government IOUs for South Sea stock. More stock meant more collateral. More collateral meant the company could borrow more. And more borrowing meant more stock to sell. This worked because of a single decision. Parliament approved it. And Parliament approved it because Blunt did something most people overlook. He distributed stock, free stock, worth real money, to politicians, their wives, their mistresses, their business partners. By spring 1720, nearly every decision-maker in government owned South Sea shares. They had a financial interest in the stock price rising. The stock price started climbing. In January 1720, it traded at £128. By May, it hit 550. By August, 890. Ordinary people, clerks, widows, shopkeepers liquidated everything they owned to buy in. Servants borrowed against their wages. Families mortgaged houses. The price wasn't rising because of any news about South American gold. It was rising because everyone could see everyone else getting rich. Here's where the standard story usually stops and declares, people are irrational, but that's where we need to dismantle the narrative. The investors weren't stupid. They were making a rational bet given what they knew. The company was backed by Parliament. The directors were wealthy, reputable men. The government itself owned stock. By every signal available to a normal person in 1720, this was safe. The real problem wasn't the investors, it was the math underneath. The company's value was entirely circular. Stock price was high because investors believed it would go higher. But the company had no actual income from South American trade. The monopoly was worthless. Spanish colonial gold wasn't flowing in. The company was making money only by selling more stock. It was a closed loop with no exit. And the people running it knew. Blunt and his co-directors were selling their own shares in May and June, even as they publicly encouraged others to buy. In August, when the stock hit its peak, the insiders had already moved most of their wealth out. They knew the mathematics. They knew there was no Spanish gold. They made the decision to extract value while the window was open. The collapse came in September. Historians still debate who started selling large blocks of stock. Maybe it was insiders cashing out the last of their holdings. Maybe it was a rival company spreading rumors. It doesn't matter. Once selling started, the mathematics inverted. If the price was falling, rational actors sold to lock in gains before it fell further. And every sale accelerated the descent. By December, the stock had fallen to £124. By 1721, it was worth 50. Fortunes that had looked solid in August were vapor by January. A widow who'd invested her entire inheritance lost everything. A clerk who'd mortgaged his house had no house and no means to pay the debt. Suicides spiked, families fractured. The wealth destruction wasn't just financial, it was social devastation. The government's response was telling. A parliamentary inquiry was launched, but most directors escaped serious punishment. A few were fined, some were briefly imprisoned. Blunt, the architect, died in 1733, a relatively wealthy man. The politicians who'd received free stock faced no charges. They'd broken no law because they'd written the laws. The system protected itself. But here's what actually reshaped Britain. The financial infrastructure changed. New regulations required disclosure. Stock markets moved toward standardization. Insurance companies emerged to manage risk. The Bank of England gained authority over credit. These weren't born from moral outrage. They were born from the calculation that future bubbles cost the government money and lost tax revenue and social instability. The bubble also permanently altered how ordinary Britons thought about wealth and risk. For decades afterward, ordinary people were skeptical of stock schemes. That skepticism became cultural memory. It took 60 years before the stock market regained the public's trust. The trauma was that deep. So what was the South Sea bubble really? Not a failure of human rationality. It was a failure of information asymmetry. The directors knew the truth, the investors didn't. The directors made a deliberate choice to exploit that gap. They moved decisively on what they knew. It's the oldest play in finance: buy low on secret information, sell high when the crowd arrives, then step aside. The cost was measured in broken families and destroyed life savings. Estimates suggest around £9 million in losses, roughly $1.5 billion in modern currency. That's not abstract. That's thousands of people whose retirement never happened, whose children went without education, whose names vanished from history. And the real legacy? Britain built a financial system more resistant to the next scheme. But resistance isn't immunity. Every generation thinks its bubble is different. Every generation has insiders who know more than the crowd. Every generation has crowds willing to believe that this time the mathematics actually works. The South Sea bubble wasn't about stupidity. It was about power, the power to control information, the power to move first, the power to leave others holding the collapse. Understanding that distinction is what separates investors who see the next disaster coming from those who get buried in it. Subscribe to uncover the decision-making behind history's greatest financial collapses and how to spot them before they happen.